The headlines are screaming. Your portfolio is a sea of red. The pit in your stomach tells you you've made a terrible mistake. It feels like you're being punished for your optimism, fined for daring to invest your hard-earned money. The natural, overwhelming human impulse in that moment is to do anything to make the pain stop. For most, that means selling. But what if that feeling, that entire interpretation of the event, is completely wrong? What if the pain you're feeling isn't a fine at all? What if it's simply the price of admission? Today, we're going to explore a powerful mental model from The Psychology of Money by Morgan Housel. It's the idea that everything worth having in life has a price, but that price rarely shows up on a sticker. And when it comes to investing, understanding the true price and being willing to pay it is the key to long-term success. First, we need to understand our default programming. As humans, we see a negative result and immediately assume we did something wrong. If you buy a stock and it goes down, you think, I picked the wrong stock. If you invest a lump sum and the market crashes the next month, you think, I invested at the wrong time. We process losses as a penalty for a bad decision. This interpretation then leads to a logical conclusion: to stop the penalty, I must reverse my decision. I must sell. This is the psychological trap that destroys more wealth than almost any other. We misdiagnose the nature of market volatility. We see it as a fine, when we should see it as a fee. What's the difference? A fine is what you pay when you do something wrong. You get a speeding ticket, you pay a fine. It's a punishment for bad behavior. A fee, on the other hand, is simply what you pay for access to something desirable. You pay a fee to get into a great concert. You pay a fee for a college education. It's the cost of entry. Morgan Housel argues that market volatility, the gut-wrenching downturns, the terrifying crashes, the periods of uncertainty is not a fine you pay for making a mistake. It is the fee you pay for the ticket to long-term returns. It is the price of admission to the greatest wealth creation show on earth. Let's use an analogy. You save up and buy a ticket to Disneyland because you want to enjoy the incredible rides and experiences. You know, going in, that you will also have to endure some unpleasantness. The lines will be long. It might be hot and crowded. It might even rain for an hour. When you're standing in a 90-minute line for Space Mountain, you don't storm out of the park and demand a refund. You don't see the line as a punishment. You see it as a necessary, if annoying, part of the experience, the fee you pay to ride the ride. The stock market is the same. The incredible long-term returns are the amazing rides. The volatility, the fear, and the crashes are the long lines and the hot days. They are not a sign that the park is broken. They are a normal, inevitable, and predictable part of the experience. The person who tries to enjoy the rewards of the stock market without ever experiencing a downturn is like the person who wants to go on all the rides at Disneyland without ever waiting in a line. It's a fantasy. Think of it another way. In terms of assets, you can put your money in a savings account. It's very safe, very stable. This is like buying a reliable, boring sedan. It gets you where you need to go with almost no drama. The maintenance cost is low, but so is the performance. Stocks, on the other hand, are like a high-performance Ferrari. They offer the potential for much higher speed and returns. But they also come with a much higher maintenance cost. They are volatile, they require more attention, and sometimes they will break down spectacularly. You cannot get the Ferrari's performance for the Honda's maintenance price. The volatility is the maintenance fee you pay for the higher potential returns of stocks. So, why is this mental shift from fine to fee so difficult for us to make? One reason is hindsight bias. After a market crash, the reasons for it always seem obvious in retrospect. Experts come out of the woodwork to explain exactly why it happened, making you feel foolish for not having seen it coming. This makes the loss feel like a penalty for your ignorance. Another is action bias. Our brains evolved to respond to threats by taking action. When faced with a sea of red in our portfolio, the instinct to do something is overwhelming. Sitting still and willingly accepting the fee feels deeply unnatural. it feels like surrender. But in investing, doing nothing is often the most powerful action you can take. And finally, loss aversion. Psychologically, the pain of a loss is about twice as powerful as the pleasure of an equivalent gain. This makes the fee of volatility feel disproportionately painful and unacceptable. So, how do you train your brain to see market downturns as a normal fee to be paid, rather than a punitive fine to be avoided? First, you must internalize market history. Study the past. You will see that market downturns are not an anomaly. They are a regular and recurring feature. The market has declined by 10% or more dozens of times. It has declined by 30% or more about once a decade. And every single major downturn in the history of the U.S. stock market has been followed by a new all-time high. History doesn't predict the future, but it does give you a powerful perspective on what is normal. Downturns are normal. Second, you must name the price before you invest. Consciously acknowledge the fee you are willing to pay. Before you put your money into the market, say to yourself, I am investing in stocks for the potential of long-term growth. I understand that the price for this growth is the high probability of seeing my portfolio drop by 30% or more at some point. I am willing to pay this price. This is the fee for admission. By framing it this way up front, you are preparing your mind to react with acceptance, not with panic, when it happens. Third, embrace automation and strategic ignorance. The easiest way to pay the fee without the emotional pain is to not look at the bill every day. Automate your investments so that you are consistently buying, month after month, regardless of what the market is doing. And then, commit to checking your portfolio less frequently. The more you watch the screen, the more you will feel the psychological pain of the fee, and the more tempted you will be to try to avoid it. The next time the market plummets and fear is everywhere, you have a choice. You can see the red on your screen as a fine, a punishment for being wrong, a signal to get out, or you can reframe it. You can see it as the fee you gladly pay for a ticket to the greatest wealth creation show on earth. A fee that weeds out the impatient and the unprepared, leaving the long-term rewards for those with the endurance to stick around. The key to long-term success is not finding a magic strategy to avoid the price of admission. It's having the resilience and the perspective to willingly pay it, year after year. That is one of the most vital secrets in the psychology of money.